Yeah, he was a guy who never made, I think, more than 15% or so in a single year. And here we are, February 2007. He makes 66% in a month, and his clients call up and they think it's a typo. They think it's 6.6%. They can't believe it. And his own, as you say, his own colleagues, employees, Paolo Pellegrini, never made much in his whole life, had very little in his bank account, and you can't blame him for urging Paulson to take some money off the table. His clients, his investors started getting nervous. Well, you must be taking too much risk here because you're up 66%. And to John Paulson's credit, he didn't take money off the table. He took a little bit, but not too much. And frankly, the trade transformed. I would argue that until then, it was a beautiful trade with an asymmetrical trade, and which is one you want to look for as a trader. And John Paulson emphasizes this in our conversations. It was a asymmetrical trade, very little downside when you're buying credit default swaps. It was basically costing about 7% a year and a huge upside. But I would argue that in early 2007, it transformed into a riskier trade because at that point he had made several $1 billion. And if he had blown it, if the housing market had recovered, if the subprime market had come back, then he would be known as the guy who almost pulled off the trade of the century and yet blew it. And he wasn't really concerned about that. He's not as worried about what people think about him. He's really focused on pulling off big trades or impressive trades and worrying about the downside. We didn't really get into it as much as we could have, but he was just as focused on the downside and making sure there wasn't too much downside on this trade. And that's what made it a beautiful trade.